Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, National Underwriter for Old Capital, Paul Peebles. And typically, usually with me today would be Michael Becker, but he is on a boat with Robert Kiyosaki. So he is teaching with Robert Kiyosaki on the Real Estate Guys radio podcast. And so he was invited to talk in front of a group of about 100 people. So he's in the middle of the ocean today. So with me today is James Eng. James is a senior underwriter for Old Capital also, and probably one of the most knowledgeable guys that I know on underwriting multifamily and office and retail. And so he had recently closed a transaction for Bonnie and Kerry Staples, and we wanted to talk to them a little bit about how that transaction was done, talk a little bit about what their history is, and just talk a little bit about the transaction itself. So I want to introduce Bonnie and Kerry right now. And guys, how are you?
Hi, good. How are you doing, Paul?
Doing good, Paul.
I'm doing great. So we recently closed a transaction for these guys, and I want to have kind of James take the helm right now and guide us through some of the questions I think are pretty important. And let's start off a little bit about how you guys got into the business. How'd you get into the apartment business, of all things?
Well, I've been in the investment industry for 30 years on the other side with the stock market and investments of that nature. And Kerry and I have done multifamily for about 5 years, or not multifamily, but single family for 5 years. And we really knew that we wanted to go into the multifamily realm, and we were part of an investment group, and we just weren't really getting the help that we needed. So we went off into another avenue to employ a mentor that helped us with multifamily, and we learned a lot of information from him on how to get into multifamily, and we just took his tools and his knowledge and his mentorship and took the plunge. And
so how did you guys, a lot of people look at multifamily and get pretty scared at the number of doors. How did you guys first get into multifamily in terms of actual investment? Did you start as a passive, or did you jump in as a lead right away?
Right. We did start out as passives, which was very helpful just in what we learned from that as well, So we started as passives. Also, we were using retirement money, which we had to use that with our, as a passive. You cannot use your retirement money for lead investing. And so with all that, we gained a lot of knowledge from the investors, how to analyze the deals, their vendors, what they did for rehabs, just sort of took their lead. And then also it was a great resource. Along with our mentor, we also had, the leads that we could ask questions and actually see how they've handled things, and then learn from that and make our own checklist of how we were going to follow through with things. So,
yeah, just to add to that, when we started this, we initially did start out looking to be leads, but as we were going down that path, we quickly determined, one, you got to build people that can invest with you. So that took some time for us to build that pool of people. In doing that, you can also build that pool of people being a passive. So you learn quite a bit being a passive, but it also expands the number of people you network with to help you build that passive pool of people for you to be the lead to syndicate your deal.
What characteristics did you look for in the lead investors that you guys invested with?
I would say some integrity, history, if we could work with them. I felt like if it was somebody I could partner with, even though I'm just a passive, if I felt enough that we could partner with them, I felt like that was good. I think, if they had a good history track record, that's obviously a much easier. But if you were a first-time investor, we didn't sway away from that. We have a couple investments that we did. It was our first time, but it was because we spent some time with them, we got to know them, and we felt very comfortable with them and that they were very capable with their investments.
As well as the property itself,
Absolutely.
too, analyzing the property ourselves as well.
Okay. How did you guys talk about some of those passive investments just at a high level? Maybe just which properties, what cities, just sort of give people a feel for what passive investments you guys are in currently.
Sure. We are in 226 Arthur Square, which is down in Port Arthur. That was actually the first passive investment that we got into, and that one actually has done very, very well. We're in Las Brisas, which is here in the Dallas-Fort Worth area. We're in CNC Mesquite, which is a 32 unit. Well, it's 232 units, so it's a total of 64. And then we're in Hewlin, which is 121 doors, and then Woodhill, which is 352 doors, and then most recently closed on Casa Flores, which will have a new name of Los Robles here soon.
So how did you guys transition? So it sounds like you had 4 or 5 passive investments done and then decided to go in and be a lead. Talk about that transition and then how you guys found Casa Flores.
Maybe start with the first deal we tried.
Yeah, that could be our funny story, right? So once we became passive investors initially, we were always in the mode of trying to look for our first lead deal. But at the same moment and the same time, even as of now, we're still looking for passive deals because, again, we still have retirement money to use for that, as well as we're continuing to look for additional leads. Our actual first apartment that we did have under contract actually ended up being a great learning tool. We didn't close the deal, but we learned a whole lot. And we just had a very difficult seller that had a property that had a lot of deferred maintenance that was not disclosed until once we went through our due diligence, and we had to make a business decision to pull out when he wasn't willing to negotiate that.
How much money did you guys spend on that one learning experience?
The amount that we actually spent was for our due diligence, which was around $3,000 to $4,000. But Kerry and I believe that was knowledge that we would have never received from a textbook. So it was we went through every single process just as if we were closing the deal. So when we found the right deal, it was just, we had already done the steps. We were just following through with what we had already learned. So.
And to add on that, on the price, it was $3,000 to $4,000, but it would have been a lot more. But we had worked with another person in the group that had already kind of tried to work this deal. So it was, again, with the networking and the relationships that we had built. And so they provided us some details to let us know, be cautious that it was a difficult seller. So we were able to hold back on some of the things like the PPM and some of the lawyer fees before we moved forward on the deal because we knew we had to get things really solidified with the due diligence. So we did save ourselves some money by having those relationships.
Mm-hmm. Yeah, so that transaction really was an interesting transaction where the borrower was less than forthright in providing due diligence information. And I'm talking about due diligence information like operating statements and rent rolls in the property. And things that he didn't disclose, which kind of was, I didn't really care for that piece of the deal, where issues with the property itself and the amount of work that needed to be done on the structure. So you guys kind of figured that out fairly early on. It wasn't a lot of money that was spent to do the private placement memorandums and put the deal into appraisals and spending $10,000, $15,000 worth of third-party fees. But $3,000 or $4,000 was cheap as an education, as taken to school, and it was good for your Casa Flores transaction.
Mm-hmm.
Oh, absolutely! I think it helped us. When we started looking at Casa Flores, because when we did Casa Flores, it was accepted by someone else that fell through, and then we were the second offer. So I definitely think that gave a lot of credibility for them to come back to us because the brokers were all familiar with what we had done on the previous property. And so I think, the $3,000 or $4,000 as a learning experience, but also to help us end up getting this deal closed as well.
So when you guys looked at Casa Flores, what did you like about the property and the market, and how did you guys decide to put an offer on that property?
Well, before we, of course, put the offer on the property, Kerry and I had went to the property, drove around the other properties. We also did a market survey before we even walked Casa Flores. We liked the property. We liked where it was. We liked that there's a church next to it. There's nice residential homes that are in front of it, and then there's other multifamily that are on the other side of it. So we just liked the general area, and then it's close to, lots of up-and-coming areas that they're trying to rehabilitate. And then every time I walked onto the property, it has these great, beautiful oak trees. And it was just a very calm, wonderful little neighborhood that you had families. When the buses let go, here come the children, And so I fell in love with the property just for all of those reasons, and love the fact that we have families there that are just trying to do life. So
yeah, and she crunched the numbers. She's very detailed in all of her numbers, and the numbers just kept looking really, really good. We were going to do double-digit returns and double our money within 5 years, which is what is our kind of our model that we go after. And it was going to meet that, actually exceed that from what our base level is. So it looked like a really good property for us. And then we did negotiate back and forth on the price a bit, but it wasn't much, and the numbers still work, so it really worked out for us.
Okay. And talk about how, you got it under contract, and then how did you guys decide to finance the property?
Well, it was a pretty easy thought process. Paul and I had relationships prior to this. We had known each other.
That's business related.
Let's clarify that.
Do I need to know something?
Absolutely. So Paul and I have known each other for a long time. So my number one thought was to absolutely call Paul. And actually, I called Paul and asked him to come walk the property with me. And he came out to the property and walked the property with me as well. So I did call and check other places as well, because as the lead, that's my due diligence to do those processes. But when it was all said and done, Paul and Old Capital and James Ng were the people that.
But on a funny note on that, she did. She called a couple other people, and then right after that, Paul calls her and go, why are you, because it came back around to him from the lender she went to.
So he knows what you're doing.
Yeah, so Paul is watching you.
So what type of loan? I know we went through the process together, but tell us a little bit about the loan that you guys put on the property and how you decided on that particular loan structure.
Yeah, so we have a what's called a 7/6 ARM, and it is a flexible APR on this. But the thing that's real attractive, number one, rates are so low right now, and I really don't see them going up anytime real quick. But also what was attractive is the prepayment penalty and the lack thereof. When our model, as Kerry was saying, is to double our money in 5 years or less, and the key word there is or less. So if we were able to make the property do what we feel like it's going to do, we could be out of this thing in 3 years. And on a lot of the loan structures that are out there on a 3-year time period, you're going to have a huge prepayment penalty that absorbs a lot of your gain. And so that's ultimately what made us decide to go with the 7/6 ARM. We thought that was the best for this property and this time.
Okay. So the 7/6 ARM was non-recourse loan.
Correct.
And the first year you're locked out, but after that it's a 1% prepay versus a standard yield maintenance that you would have on another deal. Okay, great.
Talk a little bit about the leverage, James, and talk a little bit about what the interest rate is on that, and talk a little bit more about some of the benefits, why people use that 7/6 ARM versus a 10 or 12-year term.
So we originally went into the deal asking for full leverage at 80% on the acquisition, and they came back and said that they could do the deal at 75, Fannie Mae. And so I guess talk a little bit about that and how that impacted you guys' returns. And
well, it definitely impacts our numbers, but we had it written at 75 because that's more conservative, and we typically always write it at 75, and then we hope and pray we get 80. Right. But it was at 75, so that's where we were already written, so it just fell in line with what our projections were.
So let me just talk a little bit about the benefits of the 7/6 ARM, just like what Kerry was talking about in Bonnie. The 7/6 ARM is an adjustable rate, but it has the ability after 1 year to convert it over to a fixed rate. So right now your rate on that loan is what?
3.52.
So 3.52, which is probably about a point or so, 1.2 or so less than what the fixed rate would be, 3.5 or whatever that number is. That's truly what the interest rate is. So think of it in terms of the fixed rate has like an insurance policy to it, that if you really want to have a fixed rate to get that rate locked for 10 years, we can do it. But what their idea really was is that they wanted to have kind of the flexibility after the second, third, or fourth year to pay off the property without a significant penalty. And a 10 or a 12-year fixed rate with Fannie Mae has a yield maintenance penalty, and that yield maintenance penalty is kind of a cash flow penalty that when we originally took out the loan, let's say, last month as an example, we promised those investors, we promised Fannie Mae that we were going to pay them, let's say 4.8 for the next 10 years. And if we wanted to either sell the property or want to refinance, then Fannie Mae would have to go out there and find a rate that was going to be competitive to what they were giving up. So if interest rates had gone down, let's say it went from 4.8 down to 4.5 or 4.25, and that was the reason why you wanted to refinance, as an example, we have to make Fannie Mae whole. They gave us this money. We gave them a contract that we were going to pay them for the next 10 or 12 years. And if we didn't do it, we had to pay a penalty to get them made whole. Well, on a $3 million loan, that could be $500,000 to determine where the interest rates are and what the remaining term is. But it could be a significant penalty. So if they wanted to pay the loan off because they improved it so much, they didn't want to pay that penalty because it would be equity that would just be taken out of their bottom line, out of their pocket, just to pay for that penalty. And that doesn't go to the bonding and carry. It doesn't go to the investors. It doesn't go to the property itself. It just goes to the Fannie Mae, the bondholder. So it does not improve the property. And so it takes away from returns. So if you know right from the beginning that you're only going to be in this property for, say, 3 or 4 years, the 7/6 arm, I think, is a great way to do it because it provides you one lower interest rate, lower cost of getting out of the loan. And it also has that non-recourse component to it. So it's almost like a bridge loan, so to speak, for Fannie Mae without it being called a bridge loan. So it does give you a lot of flexibility. Again, after the first year, if you want to, you can modify the loan without paying points and fees. You just modify the loan from an adjustable rate to a fixed rate. So we don't typically talk very much about the 7/6 arm, but this type of loan was perfect for them. Anything more to add to that, James?
I mean, most of the time, if you want to get out in 2 to 3 years, most people are having to take bridge loans that are recourse and typically not 30-year amortization. So this fit well and allowed them to hit all their goals and give them the flexibility that they needed.
Absolutely.
Any other surprises during the acquisition phase that you guys want to talk about or that you learned maybe on this acquisition so that the next time on the next one you'll be more prepared?
Sure. Well, James, we worked closely with you, of course, on this, and James was awesome at keeping me apprised of what was coming next and giving me a heads up of this is what they're going to ask for, this is what we're going to look for. And so I was prepared when he had to ask the question, or when the lenders would come in and ask the questions. But there was one item that did come up just as we were getting ready to close, and there was a HUD had to sign off on the loan because of a HUD requirement that they had on there. And it was, just stating that it was really a simple statement that this would remain an apartment and we would, not tear it down and we would not add any additional apartments to it, but they had to sign off on that statement. And so the challenge with that the only challenge is we just had to wait for them. There was nothing else we could do. But other than that was the only real huddle I felt like that we went through that we couldn't control.
So originally the transaction was supposed to stay with the delegated underwriter of Arbor at the time, but because HUD had this, I guess it's not necessarily a lien, but just because they had some HUD requirements, it had to go up to Fannie Mae for the waiver on this particular transaction. So just knowing that up front, maybe next time then
Absolutely.
we'll be more prepared and sort of build it into the timeline. But in this transaction, the seller was accommodating and allowed us to extend in order to meet the financing.
Right.
So what are your plans now going forward on the property and possibly on your next acquisitions?
Well, the property itself, we're in full-fledged rehab right now. So changing the name is our forefront and first primary goal. Changing the name and changing the curb up appeal so that it does attract the people. And so just our primary goal on any of these properties is to improve the community itself and connect the families, and whereby that also is beneficial to our investors as well, because it's sort of a win-win. That when we've got happy tenants, we've got happy investors as well. And as far as our next steps, we're actually going to visit a property tomorrow. So we're, still on the goals, on the hunt to purchase other properties as well.
Yeah, our goal is to close 2 more deals this year if we can. That's really what we'd like to achieve.
Let's kind of talk a little bit about that because I kind of find it interesting that you guys were a passive investor in a number of transactions now that you've kind of tasted the honey as being a lead, and now not only have you raised a lot of money in this acquisition, because again, how many doors was this one?
106.
106 doors. Now your next transaction you're looking for is not too terribly far away. It's right down the street, so to speak. that you're just looking at, and then it becomes economies of scale. So the property is probably within about 4 blocks.
Yep.
4 blocks from your property. They came on the market that has an opportunity there. But this is not what you do for a living. I mean, you have a full-time job, Bonnie. Kerry, you have a full-time job. You have a full-time property manager that oversees the property. So if you guys can pick up another property in and around that area, that's just going to be great for you. So you'll have, that the property that you're looking at maybe have sharing in personnel. So you can, instead of having, say, 1 or 2 or 3 people, maybe you'll have 4 overall or 3 overall. And you have somebody that slides back and forth between the property you currently own and possibly the property that you guys want to buy. So then you can have your expenses lower, which makes you more profitable to your investors. So again, this was an opportunity. And one of the things that I wanted to touch upon, and I forgot to mention about that 7.6, and people have heard me say this, but I think it's true, is that if you are buying a property that is a kind of a value-added property, because this had a value-added component to it. Again, how much money were you guys going to put in for rehab to the property?
A little over $400,000.
So $400,000, and we did the acquisition price plus the rehab, and then times that by 75%, and that was the loan amount that the Staples got. Now, when you buy a property of that size, I say like buying these properties are like done in dog years. That 1 year of ownership is like 7 years of multifamily ownership. So if you own it for 3 years, it's like owning it for 21 years. And the reason why I say that is that people sometimes in the 3rd or 4th year make decisions about these properties that they say, well, we don't like this business and we want to do something else with the money. Or they say, we can't wait to sell this property because we want to buy a 250 unit building. So that 7.6 ARM, falls into that 3 to 4 or 5 years. And that, you can sell the property and take a small prepayment penalty instead of a large prepayment penalty. And also too, is that when we talk about, people when they assume loans, if it's an assumption for Fannie Mae, and Fannie Mae allows these loans to be assumed, but they allow it at 75%. So if you are able to pay off this loan, and give the property, sell the property to the next person coming up, instead of 75% leverage, which they would have to do with an assumption, the next person coming up can get up to 80% leverage in the next transaction. So they're more likely to put new debt on the property when the property sells than having somebody assume the current debt that's against it. Not to say that's not bad debt, but instead of doing 25% leverage, a down payment, they would put 20% down. There's a lot more people that are willing to put 20% down than 25% down. So that's another good reason why we used kind of the Fannie Mae 7.6, kind of a bridge loan for people that don't have long-term horizons of ownership, but they want to get in there, improve the property, and then get out, and then keep their downside with the non-recourse available. Anything to add to that, James?
A lot of brokers that we talk to on that assumption point, they're saying if you're able to offer it free and clear, you're able to get 25 to 50 basis points lower on your cap rate if you're able to offer it free and clear versus having an assumption on there. So it definitely gives you more and better returns for your investors later down the road. So any other advice that you would have for investors looking to either jump in as a passive or even as a lead? So anything that you would tell yourself maybe 2-3 years ago before you got started?
I would have just said, start sooner than later.
Absolutely.
Because when me and Bonnie got married, we both started talking to each other going, we both wanted to be in real estate. So that's how we kind of got started in single family. We just bought a new house, got married, rented our first 2 houses. That was our first 2 rentals. And then we picked up a couple other rentals because we saw that was a good way to go. We felt like, and then as things went, I ended up getting laid off from my job. And I was like, okay, well, let's just go multifamily because we kind of felt like that was a way. So we joined up to some of these mentor groups. And once we got into a really good one, we've been just going for 18 months. We have over 1,000 doors and just closed on our first deal. So it can happen really quickly for you if you just go after it, really.
Stay focused.
And stay focused.
Yeah, and start early. I'm telling my children now, start early, do multifamily.
Any words of wisdom for also some newbies out there? I know we just talked about, go early, try to get into the business. One of the things that, so I'll take that question. So one of the things that I tell newbies out there looking to get into the apartment business is, where they ask me, what's the rookie mistakes out there? And my first thing is on rookie mistakes is the believability of what the broker says in his packages of how the property is being operated. My suggestion is do your numbers. Don't take the broker's numbers. I will tell you that with some exceptions, 90% of the brokers out there, that these are the people who actually sell the property on behalf of the seller, that represent the seller. 90% do not own multifamily properties. And so they go with market expenses and market incomes, but they don't really have a general feeling if they own the property exactly what those expenses are. So my 2 cents would be for rookies is see through what those expenses are, those market expenses and market income is on the property when they create a pro forma. Talk with people, just like when you guys have a property management company, talk with the property management company, kind of figure out what those expenses are. What is the true number? Because the property management company will put this in writing, and that's what they have to kind of commit to, because you're committing on their behalf to how they're going to deliver these rate of returns on these properties. So my 2 cents is don't so much read what the brokers say, read what you and your gut tells you after having some good mentors go through the numbers, and what your property management company says too. Now, the person that you bought that property from, the broker on that one, he owns properties, so he was more realistic in how he underwrote the expenses and, say, income. But I would say, again, 90% of the brokers out there do not own multifamily. They really don't have a capacity to understand how this thing, they have general working knowledge, but they don't understand exactly when the ball goes over their court, how these properties actually operate. Anything to add to that, James?
The one thing I'll add to that is, to what Paul is saying, is you really don't have to know it all. You really don't. If you have good mentors and you have other people in your network that you can ask questions of, like we go to other leads and ask them questions, how did they handle things? So we're not in this alone. It's sort of like a team sport, because we really do have some good resources, some good networking. So if you have questions, come up to Kerry and I. If any activity we're at, we're always willing to talk multifamily. I mean, you'll see it in our eyes. And most people are willing to help you out, and it's no secret. Our information is your information. We will share what we have.
Yeah. And when we did our market survey, the other thing you'll find, the property manager at the other properties, very giving of information. Most people are scared to go in there and say, hey, I'm about to buy this property, and they're very open to give you as much information as you want. And even the property right next to us, we sat down and talked with the owner and, kind of built a relationship with him to say, hey, let's work together. And so he was going to spend 15 minutes. He ended up spending like an hour and a half with us, just talking to us about, what he saw, some of the deficiencies with the property were, what we needed to do, what he felt like we needed to do. And he's already took over another property that he's fixed up. So, to get that from another property owner, I thought that was real insightful. So don't be afraid to talk to the other properties around there and let them know what you're doing, and they'll give you a lot of good advice too.
All right, great.
That's great advice. Now let's talk about, you've been a passive in a couple transactions. Now you're the managing member of one transaction. You've learned a little bit. What's funny, you and I have known each other for 20 years. You've gotten into this business. It wasn't so much my encouragement, but it was encouragement from your family and Kerry and everybody. Any funny stories out there that you can think of getting in this multifamily business?
I don't know necessarily the multifamily business. I guess maybe us switching mentor groups is a pretty funny story. If you want to go into
ahead,
that.
you
No,
go ahead.
you're the storyteller. Should we
I don't
read
know
your
what
story?
you're telling.
Whenever we were at the other group, and maybe not. That's not. Anyway, yeah. I mean, we were a member at another mentor group, and we were trying to get connected. And I was just, because after I had got laid off, I was like, hey, let's do multifamily. So I was full bore, and we spent the big chunk of change over there to get into that mentor group. And I just never really was getting. I mean, we were working at trying to get things connected. We never could get connected, but regardless, we were still working the system. And then we got another email to say, hey, here's another mentor. You want to go to them. And I said, okay, that's fine. It's free. We can go pick up. Maybe we'll just learn some stuff. And when we get over there, Paul happened to be over there too. And we asked Paul, hey, what's the difference here? And he goes, well, I'll let you decide. You sit in and you tell me what the difference is. And so anyway, after we sat in there about actually on the way over there, I was already complaining, going, why are we going here? I already spent a bunch of money over there. I don't want to spend money over here too. And anyway, so regardless, we get over there, and after about a half a day, I was like, okay, yeah, this is a much better program. And like I said, since then it's been 18 months, and we've been just going like gangbusters because we're in 6 deals, but we've had opportunities to jump in a lot more deals than that. We just pick and choose which ones, evaluate, crunch the numbers, and figure out which ones work best for us, and that's the deals we jumped in. But we had opportunity to get over there. After I was there for almost a year, and I got in 0 deals.
Right. So proof is in the number of deals, right? Anything
Absolutely.
else on that? So I know you mentioned, reaching out to other people. So how can people find you and reach out to you if they have any questions about your past experience, whether it's your current deals or any future deals?
We do have a website. So it's staplesmultifamily.com. And on there you can see the current deals that we're in and any current deals that we're actually working. And then also our email addresses and phone numbers are on there as well.
And I think my picture's out there if you want to see what I look like.
Actually, I think I know our pictures are on there.
Well, it sounds like you guys have done a lot of things right, and I think the proof was in the pudding also is the day after you closed, you jumped on a Bahamas trip, and you put the property after you closed in the hands of a qualified property manager. So now you as the asset manager or overseeing the property, you don't have to spend a whole heck of a lot of time on it. You just you manage the manager on the property. So that's great for you. And guys, I can't thank you enough for the business. We do appreciate it. Thanks for coming in and sharing the story with everybody. And again,
one other thing, let me jump in there now that you mentioned that, Paul, is because once we took over the property and we had the property manager there working and everything, me and Bonnie, a funny story, we keep going over there like, shouldn't we do something? And they're like, no, we got it. You've already told us what you want to do. And we're like, yeah, but we need to be doing something. So seriously.
So we went to the Bahamas and got out of their hair.
It was a struggle for us to not feel like we just tell you what we want to do and then we don't do anything. It's like, so it's like, it was a bit odd for us, but we're understanding the process a little bit better. But we get in there and we like to do, but anyway. That was one of the little funny points. I felt like that we felt like we needed to be doing something, and there wasn't anything really for us to do. He was taking care of it.
I think he was glad we got on the plane.
Well, that's great. James, thanks for hanging with us in the podcast. Kerry and Bonnie, thanks for not only being an Old Capital client, but thanks for being friends too.
Absolutely.
So we appreciate that. And we'll talk to you soon. Thanks.
Thank you.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.